Hey, welcome back, folks, to the Ray program. It is a good thing we have Tim Morton on the program. Tim, welcome to the show. How you doing, brother?
So good, Ray. How you doing?
You know what? If I were any better, I'd be you or Gene Pastula, actually, because he's over in Italy right now with my peeps. Actually, Sicily, which is really my peeps. That's my dad's side of the family. Where's you're half Italian. Where are your family? Where's your family from?
Florence area.
Okay, so
northern Italy.
I love Florence, one of my favorite places. Anyway, best to Gene. I got an email from him the other day. I asked him how the vino was. He said it goes down a lot easier there for whatever reason. I think he's a lot more relaxed. Okay, last week we talked about MIGAs. What is a MIGA?
A MIGA is just a multi-year guarantee annuity.
Okay, so a multi-year guarantee annuity. Now I get this stuff, as you do, from all over the place. And last week we talked about how somebody could actually go out and earn 3% in a 2% world from an insurance company. And of course, people say, well, the insurance companies are not that safe. Have you ever seen one that went broke and people didn't get the benefit that they were entitled to?
Actually, no, I have not. They're very safe, and they have some other state guarantees, and their whole reserve requirement is different than, let's say, GAAP accounting.
Yeah. So I mean, it's just not a worry. It's not a worry. I mean, of course, an insurance company could go broke, but it just doesn't happen. I'll tell you, in real life, we have had a few that have gone broke, but the people still got their money out, and the reason they got their money out is because the states come in, and the state says, you know what, XYZ insurance company is not doing so hot, so if you guys want to keep doing business in my state, why don't you big guys, you know, the big dogs from New York, why don't you guys come in and buy their assets? And the big dogs, of course, they want to stay in California, Missouri, wherever they are, and they usually buy the assets out. The only thing I've ever seen is the interest rate go down. In other words, they offered, 6%, and the new guys come in and say, we'll take the assets over, but we can only guarantee 4%. Okay, so what? There was not a loss of principal. And then as Tim pointed out, there's also state guarantee funds. But people are so anti-annuity. So I get another one of these MIGAs in my box the other day. And anybody can buy it. You can buy this thing all the way up to age 100. Sometimes they cut you off at 80, 85. Not this one. All the way up to age 100. And they will pay you something like 1.8 or 2% for the next 3 years. Guaranteed, tax deferred. And if you compare that to buying a CD or a treasury you might get 0.97, right? So you can get 2% in your right pocket, and it's pretty darn safe, pretty darn safe, dang safe. Or you can get 0.97 in your left pocket, go buy a treasury, and where it's absolutely safe. Now you can get your interest. They send you the interest, so if you needed the money to live on, the interest to live on, it's a 3-year, out. So if you need the money before 3 years, then don't do it. But if you're buying a 5-year CD, this is going to pay you more than a 5-year CD is going to pay you. It's going to pay you almost 2%. Now, again, these rates could change on a daily basis, but what's wrong with that, and why aren't people jumping on that bandwagon?
Well, we promote these all the time because they're so safe. It is backed by the faith and credit of that insurance company, and so we try to stay with the higher ranked type insurance companies, but we really compare them to where people are saving their money waiting for the next interest rate CD to happen.
Right.
And so the only reason they go to CD sometimes is to go to longer terms, like the 5-year, to get that 2.5% CD. But they're sitting in a money market account at less than 2.5%, or less than 0.25.
Yeah, exactly.
25 basis points, or maybe even a passbook savings account, while they're waiting for a CD rate to happen. Well, that's where the cost of waiting really affects you, because if you could get 3% today for 5 years or 7 years, what would the CD rate have to renew at next year or the year after in order to just catch up if you were in the, versus being in there today? It's like 5, 6, 7, 8% when you start looking at down the road. The math just works that way. So if you can guarantee a 3% today, why not do that rather than waiting in a 0.25%
Yeah,
rate?
and you can take the earnings out. In this case, if it's an IRA, for example, you can take the required minimum distribution without a penalty, all that stuff. And the one I saw was, I think it was a little less than 2%, and it was a 3-year contract. So, interest rates might be higher in 3 years. Tim's point is, okay, so if you wait 3 years for the 4% rate of return and you earned 0.1% while you waited, you're going to be worse off because you would have been leaving a couple of percent on the table for the next 3 years while you're waiting. The cost of waiting is astronomical. Okay, so we know intuitively, academically, that these MIGA products will produce better rates of return than CDs. That's a fact. If you just do your homework, you can find out that that is a fact. Now, it doesn't have the full faith and credit of the United States government or the FDIC standing behind it. There are some state guarantees, but it's also a fact that these are exceptionally safe. So now, Tim, why don't people buy them? I go through this with Lynn Rowe all the time. Why is it that there's such an aversion for individuals to take advantage of something that we know is good for them? We know that it is safe, it'll do a better job, but they won't put their money in, and they continually put money in banks at inferior rates of return.
Well, most of the people that do that, I think, are just, they're really thinking about the guarantees. So the guarantee, the backup from the FDIC, that definitely is a plus, you know. Where the insurance company is every bit as safe, I think, in most instances for exactly the same reasons. They have all the reserves that are going to be able to pay those interest rates. Otherwise, they wouldn't offer the rates. And they also have liquidity. They have 10% free out or 15% free out. So even if interest rates did spike up, you could get out of those products early, at least percentages of them. And if you've said a 3-year CD or 3-year MIGA,
yeah,
you could get out within 3 years anyway.
Right, exactly. Here's my take on it, all right? Mm-hmm. My take on it is the media has been so down on insurance companies, and most of us have had bad experiences with insurance companies, property and casualty companies, our automobile insurance or wherever, where we feel like we got screwed. So all of a sudden we would then translate that to virtually all insurance companies are bad. So these life insurance companies, which basically stayed in business, kept people employed during the Great Depression, fed their employees, have been here for the long run. Most of the big buildings you see have been financed by them. Those guys have gotten a bad rap.
Right, I think so. I look at life insurance companies. What are they? They're supposed to be around for a lifetime.
Right.
And most have. You see them being around since the mid-1800s, you know, and they're still around today. It's because they are so conservative and so safe that they are, and they put their policy holders first over shareholders or over other big banks.
Okay, so here's the deal. Can you stick around? Because I got all kinds of stuff to talk to you about today.
Certainly can. I'd like to talk about income planning if we can.
Well, it's my show, so you're not, what are you going to do, take over here? Coming back, it'll be the Tim Morton Show. Stick around. I guess we're going to talk about income planning. But first, we're going to talk about the stuff I want to talk about. Income planning. I invented that. You know that. I invented income planning. Stick around. And by the way, if you want information on MIGA, the multi-year guarantee annuity contract, in lieu of say a CD or even a bond, go to safemoneymonitor.com. Safemoneymonitor.com. That's the website that Tim and Jean Pastula run, and they'll get you all the information. Hey, do your own due diligence, do your own homework. You will see, as I have seen, that this is one heck of a deal. It's one heck of a deal. Okay, income planning when we come back. Don't go away. Now, before we get into income planning, and this all plays into the income planning that my special guest Tim Morton wants to talk about, because he's now taking over my show. But what I had on the docket, and you can play into this, Mr. Tim, I went through in my brain all of the risks that people need to manage. And in the summits that we do, I cover this a little bit. Let's go through the 9 major risks that individuals need to cover, or at least manage, before they even get to income planning, because income planning satisfies some of these. There's longevity risk. There's market risk. Stock market could crash. There's sequence of return risk. There's inflation. There's deflation. There's income taxes. There's interest rate, healthcare, and unforeseen events. Now, Tim Morton, you're in the risk management business. Do you see how I tie this in?
You did really good on
Okay,
that.
so being in the risk management business several of these you have product solutions for that people need to be thinking about. In the longevity risk area, you're involved in income planning and using lifetime income annuities, index annuities with inflation riders and all that other stuff. I know that from having known you for a long time. Talk about that. I mean, I've discussed the Morton study. I've gone through academic research up the wazoo. Whether or not it's resonating, I think it is. I don't know because I don't sell the stuff anymore. But the fact is that there's so much research on longevity that people that don't postpone their Social Security, that's the best annuity you can buy longevity insurance or buy a lifetime income strategy, they're really making a mistake, aren't they?
I believe so. I mean, longevity is the biggest risk of all. We call it the risk multiplier. I mean, it wouldn't matter about market risk or interest rate risk if you only lived 3 or 4 years into retirement, would it?
Nope.
You know, so if you live 30 years or 35 years into retirement, now you've got the longevity risk that multiplies all those other risks, because over that 30 or 35 year period, one of those other risks are probably going to come into play.
A good point. I hadn't thought about it that way. The longer you're alive, the more likely one of those other 8 risks are going to affect you. Let's move on to the, I don't want to talk about market risk because it's pretty obvious. If you bought a guaranteed fixed contract, you don't have market risk. So you guys satisfy the market risk. But you should talk about the indexed annuity concept, because they're not getting market returns, but they're getting an interest rate based on market-like returns.
Correct. And when you're doing income planning you use these income riders that are on these annuities, and they're really good. And it doesn't matter if it's a variable annuity or fixed annuity that you're using for the base, but the fixed indexed annuity gives you some growth potential without the market risk. And it also then converts into an income stream that's guaranteed for your life or the life of you and your spouse. And when you factor those guaranteed income streams into your retirement income plan, we try to look at the income side of it, not just accumulation. We're looking at income planning. So if this is your income need, here's your income guarantees that you have, like Social Security or pensions and those kinds of things. There's always a gap left over. That gap of income has to be satisfied one way or another. It has to come out of your portfolio, out of that 4% distribution rate, or we can satisfy that a lot of times just with a fixed, guaranteed income stream from one of these indexed annuities.
Okay, so the rub on those, of course, is inflation. They're not indexed for inflation. Now, before you answer that, I can tell you that Wade Pfau did a study on this, and he determined that just a straight lifetime income annuity was better than buying TIPS, Treasury Inflation Protected Securities, and better than buying the inflation adjusted annuities. But the index annuities that you've shown me in the past have, it's not really an inflation rider, but can you explain how it addresses inflation in the future?
Well, there are a couple of things there, but one of the product strategies that we have actually will give you raises throughout your retirement. So once you begin income, every time the index goes up, you get a raise. And that's throughout the entire life of the product.
Yeah, I've played with some of those income spreadsheets that you and I fiddle around with from time to time. We're both kind of spreadsheet nerds. He corrects my math from time to time, which is it's hard to screw up a spreadsheet because the computer's doing the math, but you got to get the formulas right and all that. In either event, Tim's an expert at that stuff. But I've done present value analyses on those, as you've seen, because I like doing that. I want to find out what kind of a bang for my buck am I getting, assuming, and there are some assumptions that you have to put in there, assuming the market performs like it's performed the last 10 years, or the last 15 years, or the last 20 years, so that you can back into what that index return might be. Now, you don't get dividends, and there's usually some kind of a spread, but I've seen those incomes double, in some cases triple, depending on how long a person lives. So there is an I don't want to say it's an inflation component because it doesn't tie to the CPI. It ties to the return that you get. So if the stock market continued to do what it's done in the past, which is go up 3/4 of the time and down 1/4 of the time, in the down years, your income doesn't go up, but it doesn't go down either.
That's the best of all worlds, is that once you establish an income floor, you'll never go less income than that. You only can get raises. It'll only go up.
Okay, let's move on. Sequence risk. You don't have a sequence of return risk because you don't have down years. There's still some sequence risk, but we address that with the right withdrawal strategy, so we don't need to belabor that. Inflation risk. These are not products to manage inflation risk. Deflation risk. These are the products to manage deflation. What is deflation? Deflation is prices going down each year, going down and down and down and down, a la Japan. A fixed guaranteed income stream or a fixed guaranteed return is tantamount to getting a raise as prices go down.
That's correct. It's the opposite of inflation. You got deflation, and yeah, if you had a steady income, certainly you could buy more when the prices go down. So.
Now, this is an interesting one, tax risk. People don't think much about tax risk, but with a tax-deferred annuity, you get to defer your taxes while you're in your highest brackets, your income earning years, and then when you take the money out, you pay tax on it, and you don't have a required minimum distribution, so you're not forced into taking any amount out at any time, but you can judiciously take money out, pay the taxes incrementally as opposed to paying taxes in a big lump sum. So if you're in a 30% bracket now and you're retired in the 15% bracket, you can pull the money out at 15. So you accumulated it at 30 and pulled it out at 15. That's a 15% tax arbitrage.
Right. I only think, though, that taxes are probably going to go up in the future. So thinking that your taxes will be less in retirement is probably not the best strategy, but you can control it. We also use a lot of income annuities, just straight SPIAs or single premium immediate annuities, and that gives you a little bit more tax advantage for creating an income stream as well, because you've got that factor in there where only a portion of your income stream is going to be taxed.
Yeah, I think the tax rates will go up for the wealthy. I'm not sure they're going up for the average person. The other thing that a lot of people neglect to realize, Tim, is every year the brackets ratchet up. So today, if you can earn $90,000 as a married couple and be in the 15% bracket, 20 years from now, that number is going to be $130,000 or $140,000. So now the rates may go up, but these brackets also go up. So more and more of your money is likely to be, unless you're like, Rockefeller or something like that, in the lower brackets, but we can debate that off the air. Health care, you're the long-term care king. You guys focus on linked benefits and long-term care. 70% of the people will need some kind of care. But yesterday we were talking about riders you can put on life insurance policy. You don't have to actually go out and buy a long-term care policy. If you're a young person, for example, you can insure against it by just adding a rider on your life plan.
That's correct. And I think after longevity, I think long-term care risk is one of the other big risks to a portfolio. Just think about having that extra $5,000, $6,000, $7,000, $8,000 hit or income need from your portfolio. I mean, that's a huge hit. And that's monthly. That's not annually.
Yeah, again, people have this aversion to insurance companies. Do me a favor, folks. Before I get to unforeseen event risk, because you could die too, that's another risk. My unforeseen event is my wife going to Saks, but that's a whole other thing. Didn't realize she was going to Saks. I want you to go to Safe Money Monitor and check these guys out and have them help you by showing you how MYGAs can help you and work for you, how indexed annuities with these inflation things can help you, how you can potentially beat CDs. And just for me, try to put the negativity that you hear about annuities and insurance companies on the back burner and check it out for yourself. I think you will be pleasantly surprised that having product diversification in your portfolio, don't put it all there, take a small piece and have product diversification, because it will help you manage at least 70% of the risks we just covered. Thank you, Tim Morton. We'll talk to you later.